David Fisher, and I'm here again today with PIMCO's Group CIO, Dan Ivascyn, to talk about some of the recent discussions taking place in PIMCO's Investment Committee, or IC. Since we last spoke, we've seen a pretty dramatic drop in U.S. bond yields, and globally we're at a point where about 30% of the investment-grade bond universe is now trading at negative yields. And there's actually been even some talk about U.S. rates going negative in the case of a recession. But how is this influencing conversations in the IC? How is it affecting our view of where the investment opportunities are?
Sure. So, within the investment committee, we've been spending a lot of time talking about the themes of the drivers of yields going lower. And what we've noticed, really since late last year, is a pretty significant slowing in global growth, driven primarily by the manufacturing sectors, but pretty coordinated or consistent slowing across the various economies that we track. That combined with significant political uncertainty, primarily focused on trade, has certainly contributed to a lot of momentum in the higher quality fixed income markets over the course of the last several weeks. And the investment committee is spending a lot of time talking about not only what has occurred, but the likely outlook for growth going forward, as well as the likely path regarding these ongoing trade negotiations as well. In terms of the outlook going forward, so we continue to be overweight U.S. rates. When you look at interest rates in the United States, you have some of the highest nominal yields across the developed world. And this is one of the few markets that has room to rally more significantly if economic growth were to deteriorate further, or the trade situation were to deteriorate as well, which we think would ultimately flow into global growth. However, we acknowledge when we look at U.S. rates today, after the rally that we've seen, there's no longer a lot of value there. Looking at our own inflation expectations and yields adjusted for inflation, here in the United States now, real rates, or these inflation adjusted rates, are zero in many cases, even outright negative. In much of the rest of the developed world, outright rates are negative. Although with that said, there's a lot of momentum in these markets. There's a lot of fear out there in these markets. So these yields, although getting expensive under more traditional metrics, certainly could get more expensive over the course of the next several weeks, especially if we see continued economic weakness.
So one of the areas that you've talked about opportunities is in emerging markets. Clearly, interest rates are a bit higher in many emerging markets than they are in the developed world. What's the IC's current view on whether there are still good opportunities within EM?
So I'd categorize our current view on EM as cautiously optimistic. The emerging markets have been volatile of late. Emerging markets will be very sensitive to further deterioration in trade negotiations, or an uptick in trade wars globally would not be friendly events for emerging markets. But we think in the context of a global and a diversified portfolio, there's still going to be select opportunities in emerging markets. As long as you stay diversified and you look at them in the higher risk bucket of the particular portfolio that you're focusing on.
Okay, so a selective approach to taking risk in emerging markets. Where else is the IC finding opportunities? Where are the highest conviction ideas globally?
Conceptually, what we're looking to do is find attractive spread. We're looking for ways to pick up incremental return in some of their higher quality, more defensive segments of markets. Two areas that I'll note that have lagged in terms of performance over the course of the last several weeks. One, agency mortgage-backed securities. This is a sector of the market where you benefit from a direct U.S. government guarantee, or at least a guarantee from two major agencies of the federal government, and where you're in a high quality and a liquid asset that provides attractive returns versus other high quality corporate alternatives, as an example. We also like select inflation protected bond markets. Although our base case is for inflation to remain relatively low, when you look at the break-even inflation rates currently embedded in the pricing of these instruments, these securities increasingly offer value as well.
So one last question. Given the volatility in markets and all of the headlines, has this changed the way the IC approaches investing?
It really hasn't, David. We, for many, many years at PIMCO, try to take a longer-term approach to constructing portfolios. What we try to really do is get together, think sufficiently long-term in nature, think about the world, with a few, key top-down constructs when making decisions, and most importantly, be patient. You will not catch every rally. You'll make some good local decisions, some poor decisions from time to time, but we always feel it's important to stick to a longer-term game plan. You also need to be respectful of the pretty significant uncertainty that we operate in as market participants today. I know our secular forums where we get together, once a year to talk about themes impacting markets for 3 to 5 years or even longer, have talked about these rude awakenings or these types of disruptions that we'll need to get used to. So we can't be complacent from a risk management perspective. What we're really trying to do is protect downside as primarily fixed income investors, be very, very prudent in portfolio structure, be good liquidity managers. And if we do this well with a long-term focus, we can react and add value during these bouts of market illiquidity. And it's that same structure, that same philosophy that's worked pretty well over the long run on behalf of investors, and we're still sticking to that general approach.
Great. Well, thanks for your time today, Dan, and thanks to you all for joining us.